Most real estate investors think they're building a tax shelter, but the IRS has a very different idea about who actually gets to use it. Let's talk about the rule that quietly crushes the passive loss stream for thousands of would-be landlords every single year. You buy a rental property, it runs at a loss on paper, and you think, great, I'll write this off against my W-2 income and pay less in taxes. That's the dream. And it's completely legal, except for one brutal little section of the tax code called the Passive Activity Loss Rules, which Congress slipped into the 1986 Tax Reform Act like a trapdoor under the real estate investing community. Here's a simple version. The IRS divides your income into two buckets: active income, which is your salary, your business, your hustle, and passive income, which is rental activity and limited partnerships. The rule says passive losses can only offset passive income. And if you don't have enough passive income, those losses just sit there, suspended, like your ambitions on a Monday morning. Now, here's where most investors get blindsided. Real estate rental activity is automatically classified as passive. No matter how many weekends you spend unclogging toilets or arguing with contractors, the system assumes you're a hands-off investor and it taxes you accordingly, which feels deeply unfair when you're the one answering midnight maintenance calls. There is an exception, a beautiful, fragile exception called the $25,000 allowance, which lets you deduct up to $25,000 of rental losses against your ordinary income. But here's the catch that nobody puts in the Instagram caption. Your adjusted gross income has to be under $100,000 to get the full benefit, and it phases out completely by $150,000. So if you're earning $150,000 a year or more, congratulations, you've made too much money to be poor on paper. The allowance disappears, your losses get frozen, and you're left staring at a Schedule E that feels more like a participation trophy than a tax strategy. The only real escape hatch is becoming a real estate professional in the eyes of the IRS, which sounds glamorous until you read the actual requirements. You have to spend more than 750 hours per year in real property trades or businesses. And that time must represent more than 50% of your total working hours. Meaning if you have a full-time job, you're almost certainly disqualified before you even start counting. Here's the irony that would make a good comedy sketch. The people who most need the passive loss deduction, middle-class earners building wealth through rental properties, are often just barely over the income threshold to use it. Meanwhile, the people with massive real estate portfolios who could actually qualify as real estate professionals often have enough passive income to absorb the losses anyway. But history gives us something to hold on to here. Those suspended losses don't disappear. They accumulate year after year, like a financial snowball. When you eventually sell the property, all those frozen passive losses come roaring back to life and offset your gain, which is the IRS's version of a delayed gratification lesson nobody asked for. The misconception most people carry is that any involvement in your rental makes the income active. It doesn't. The IRS requires material participation under very specific tests, like working more than 500 hours in the activity, or more than 100 hours if no one else works more than you. Casual landlording doesn't count, and neither does good intentions. The practical lesson here is to know your income before you build your tax strategy, not after. If you're hovering near that $100,000 adjusted gross income threshold, aggressive deductions, retirement contributions, or business expenses might bring you back into range, where that $25,000 allowance becomes real money. If you're above the threshold and not a real estate professional, the smarter play is to pair your rental portfolio with other passive income streams, syndications, partnerships, or additional rentals, so your passive losses actually have passive income to offset. Think of it less like a tax break and more like a puzzle where you're building the pieces to match. The deeper truth is that the passive loss rules weren't designed to punish real estate investors. They were designed to stop high-income earners from using paper losses to shelter active income in the same way tax shelters were being abused in the early 1980s. Understanding the why behind the rule actually makes it easier to work with it strategically rather than fighting it emotionally. Discipline here means knowing exactly where you stand before December 31st, not scrambling to find deductions in April. Position size matters too. Owning one rental property with $20,000 in losses and an income of $200,000 is a frustrating, suspended situation, while owning 5 properties with a real estate professional spouse changes the entire tax picture. At the end of the day, the passive loss rules are a reminder that tax strategy is not a bonus feature of real estate investing. It is a core part of the business model, and every decision from purchase price to ownership structure should be made with the full picture in mind. And whether those losses flow through this year or wait patiently for the sale, a well-built portfolio wins either way. If you want help navigating any of this, whether it's real estate investing, home contracting work, or finding the right lenders, check out our links in the description below.